We'll do it live.
Okay.
We'll do it live. Fuck it. Do it live. I'll write it and we'll do it live.
Hello, this is Dylan Moore and Nima Major of iRead It TV coming to you today. It is Tuesday, August 30th, 2022, and we are here doing it live. And oh my God, we got something, at least we find, incredibly exciting to talk about, which is the private banking system. Are you interested in making some money, Nima?
Yes. Been all my life.
So, we stumbled across a YouTube video by a guy by the name of Professor, Richard Werner?
Yeah.
Professor Richard Werner, or Werner, because I think originally he
Richard Werner.
Yeah. And as two MMTers, we call ourselves, we were very fascinated to hear this because we do talk about the private banking system here, but we've never heard it broken down in such specificity as we did with Professor Werner, and we wanted to just go over it because it's some pretty cool stuff. And it starts with this video where Professor Werner's getting interviewed, and he goes over that there's three different interpretations of the banking system. And just having these different interpretations separated and addressed specifically totally helped me reevaluate and helped understand how to understand this, because once you understand that there's three different interpretations and you start hearing this conflicting information about how the banking system works, you can go, oh, that's from this interpretation, or that's from that interpretation, or that's from this other interpretation. And once you combine it with an understanding of MMT, and from is what I'm able to tell listening to this guy, he doesn't appear to be what we would call an MMT guy, right? It just was like hand in glove with our understanding of MMT, and what we're always focused on. What can you take and do with this? Understanding how the banking system works. I'm not going to say it now. We'll leave it for the end. What the answer is, what to do with this information, right? Because he does go over that. Let's see. Nima's pulling up. Let me.
It's no sound. I just pulled up the conversation so people know what you're talking about.
Yes, and I was turning off my camera so they could see it. Yeah. Oh, at the Rhodes Forum. Good stuff, right? So this is probably Globalist Hub Central with Professor Werner coming on talking about how central banks, not all of them, but a lot of them, particularly the European Central Bank, are just totally screwing stuff up. Oh, OBS. Why are you playing with me like that? There we go. Okay. So, Nima, should we go over what these three interpretations are?
Yeah.
And
yeah.
How he figured them out. Like, there's an empirical test involved with this, Nima.
Mm-hmm. Mm-hmm.
What would you ever imagine in your life that someone would do an empirical test when talking about banking?
Yeah, it's a very theoretical field, and in general, just the whole 20th century economics has become very theoretical and academic, and so it is kind of pathetic, if you will, that it took I don't know how many millennia for somebody to actually do an empirical test of how banking works.
How does this actually work? So Werner goes over that there's been three different theories of how banking works, at least within the last 2 centuries. And that from the 60s until now, I think he said the 60s, or maybe it was the 70s. From the 70s until now, we've been operating under version 3. From the 20s until the 60s was version 2, and up until the 20s was version 1. Version 3, we'll start with that because that's what everybody is working with at the moment, and what banks base their policies off of, is banks are just intermediaries. They just collect deposits and they loan those deposits out. So theoretically, banks don't actually do anything in the economy. They're just a middleman. And the regulation is geared around them being the middleman. And they use what's called the Basil Approach. And Basel being like this city in Switzerland, Basel, where the bankers all meet and discuss what they're going to do. And the Basil...
It's also where the Bank of International Settlements resides.
There we go. And the idea being with the Basil Approach or the middleman theory is that the way that you prevent banking crises is by making sure that the banks hold a certain amount of capital. Like if there's a crisis, they have enough capital to cover whatever the crisis is. And then Werner points out that since this theory has been accepted since the 70s, which is about 50 years ago, we've had about 100 different banking crises. I presume he's talking about the whole world. I'm not sure here. But we've had about 100 different banking crises. And despite the fact that the whole banking system seems to be smashing its face into a brick wall, they still keep smashing their face into the brick wall going, well, we'll just try harder this time. And he points out that, regardless of the three theories that we talk about, banking is all about regulation, because how the banks are regulated is determining where the money flows. So if we have a wrong theory about how banks work and we regulate around that wrong theory, we're going to get some interesting results, like 50 years of 100 different banking crises. That's 2 a year, Nima. So,
well, also important to point out that banking is essentially a bureaucratic activity. It's a government public partnership, and to the extent that it's public, you need to regulate, you need to have rules in place in order to make sure they don't abuse the privileges that have been granted. As we've discussed before, libertarians would say that regulation is bad, regulation is bad. Okay, do you want to not regulate the military then and not have any rules for the military?
Yeah, you do not want to regulate like the state itself. Like
right.
it's a state apparatus. Another point that he made here, and this might be one of the more important points, is that this theory, this banks are just intermediaries theory, is reinforced by the financial news reporting, it's reinforced by central banks, and it's reinforced by academic and research literature. So from all angles, except from him and I guess from us now, you get reinforced with this theory. So what's the second theory?
Yeah, so the second theory is the one that you have listed. Okay, so the one that's the money multiplier.
The fractional reserve theory.
Fractional reserve theory, dominant from about 1920 through 1970s, and it says that that banks
they're still intermediaries.
They're still intermediaries. They keep a portion of the reserves on their account, but they lend out more money than they take in reserves.
Well, the way that Werner explained it, I thought was very interesting. He said that, first of all, that this is very confusing, and then it's intentional that it's confusing. Is that, okay, banks are intermediaries. They collect and deposits and loan them out. However, when you have many banks together and they start existing in a network, something happens where money gets created, which I think is what Nima just said, is somehow they're able to loan out more money than they actually have. And he says that the proper approach to bank regulation with this theory is the old reserve requirement approach, and regulations were geared toward this until the 80s. And, I mean, I guess you still saw vestiges of it. I mean, up until the COVID crisis, we still had a reserve requirement here. I remember Trump emphasizing to knock the reserve requirement down to 0. I don't know if it's remained at 0 or not. But even if it has remained at 0, and it's been 0 in several other countries, that kind of proves that this theory doesn't hold water.
Right. I mean, it's been 0 in Canada for like forever, and they haven't had hyperinflation.
Right.
So, this regulatory approach leads regulators to the conclusion that having a reserve requirement is useful, and that there's a point to having a reserve requirement.
Right.
And we haven't seen any evidence of that. And it's also in the mechanics of the systems, even logically, there's really no reason for that approach to ever really make any sense or bear any fruits or restrict the bank's behavior, regulate their lending, any of those things. It's just a ritualistic thing that they do, but there's no real purpose to it.
Right. The third theory, the money creation theory, which is a theory that we espouse here, is, all right, it was dominant, and when we say dominant, I guess he meant this is dominant in the academic and financial literature, up until the 1920s. And the explanation for this is basically what we've been saying here all the time, is that banks create the money out of nothing. When you get a loan, they're not taking somebody else's deposits. They're not multiplying a reserve value or something. They're just literally writing something into an account, and there's the money. And I've heard this a lot before I got any sort of exposure to MMT, that yes, we have found out that when you you sign the loan documents, you have just created a promissory note that the bank purchases from you. And then that's what they're able to trade around. And usually in the circles that I heard about it before, that they were all up in arms like, oh my God, you didn't actually lend me any money. This is horrible. I'm going to sue you. Whatever. That was the attitude, as opposed to what I think should be the proper attitude of like, okay, this is just how this thing functions. Money gets created through this method. Now, Werner says on the video, well, which one is it? And he said, I decided to empirically test this, which is to say he wanted to find a bank where he said, I want to come and take out a loan, and I want to see exactly what's going on in your inner system to figure that out. And it took him a while to figure that out to find a bank because no bank wanted to show them their inner system. He said he found a local bank in Germany at some point that lent him 2,000 euros. And when they looked at how the numbers moved, no money moved from any account anywhere.
I think it was 200,000 euros, if I remember correctly. But
I thought that's what I said. What did I say? 2,000?
I thought you said 2,000.
Okay, that's right. It was 200,000. He gets, in quotes, loaned 200,000 euros, and then he moves it to another bank, his bank. And in that process, no money from any other account in the bank moved anywhere, conclusively proving that the money creation theory is true.
Yeah, I mean, he basically had them really give him snapshots of what happens to the individual accounts in what moment. And yeah, that's what he walked away with. The bank created the money out of nowhere. And when you transfer the money to another bank, then obviously that bank is going to request reserves from this bank. The reserves move over. And that's it.
Mm-hmm. So what do we extrapolate from this? We're going to extrapolate a lot. But the first thing that hit me is, again, simply identifying that there have been three different interpretations. Because when I've gotten information, depending on the source it comes from, nothing makes any sense because oftentimes the information is conflicting. And I think particularly from people who have, say, that they've decided that the Federal Reserve is a private bank that's super evil, that that we have to borrow money from, and so on and so forth. I'm guessing, I'm theorizing here, that they've actually gone backwards in time and looked at the literature and looked at the understanding back in time, and they're picking from that era, not realizing that there's three distinct eras to pick from, right? So if you're not aware that these three distinct eras of understanding and theory to pick from, and you're just picking these three different theories, which are completely contradictory to each other, then you're just going to end up with a mess. And on top of that, the fact that Werner does do this empirical test, he figures out that it's theory number 3, which is the money creation theory. Because the money creation theory is contradictory to the other two, what that also means is that economics, unless it's pointing at the money creation theory, it's just like voodoo. It's just total made up nonsense. At least, talking about the banking system for this specific case right here. So if economics is total voodoo made up nonsense, what would you expect? You would expect 100 banking crises in the last 50 years, right?
Yeah, they're basically, it's voodoo, but they're stabbing in the dark, you know.
Right. So he makes a very, very interesting point, and multiple points. The first is, and this isn't news to me, but I'm going to reiterate it here, is that the banking system creates about 97% of the actual money in our system. 3% comes from the government, 97% comes from the in quotes, private banking system. And if we recognize that money is created when loans are made, what this means is that this is a really, really, really important aspect of our entire society, is how this banking system works and what they direct the flows of money towards. Because if they're just intermediaries, if they're just middlemen, then that doesn't matter that much, right? If they're the actual money creation system within the society, then what they create the money for is going to very heavily influence what that society ends up doing economically, right?
Yeah. Yeah, they're basically shapers of the entire economy. They are the masters of the economy, if you will. They decide who gets spending power and who doesn't. And then what that spending has to be directed to, if it's a business loan or whatever. And then also that nowadays they make consumer loans and all those things. So yeah, their role is of primordial importance within the entire Western, probably the whole world's economic money system.
Yeah. And he does emphasize, and we definitely want to get him on to talk about stuff like this, that there are central banks actually have a bit more power than I thought they did, coming from the MMT perspective, but they have a different type of power than I thought they did. And I don't want to get into that right now because I don't remember it enough off the top of my head to talk about it. But I bring that up because the thing that we're talking about right now actually isn't influenced by the central bank. Where the individual banks on the ground are choosing to throw their credit is not something that the central bank necessarily cares about, right?
Well, the central bank can make regulations in terms of which loans are to be made, or some regulatory agency can make them. They just happen to sort of, for the past decades or so, they haven't really done that. You know, they've stepped back from it.
And they focused on interest rates.
Rate manipulation, exactly.
Which we could talk about later. The point I wanted to make is that 2 points. If we understand this, that, okay, the bank, that one right there down the street, has power to direct flows, obviously within the scope of regulation. It's not the central bank going, okay, I'm gonna throw my weight over here or throw my weight over there. They do have power to do that in some aspects, but not specifically in the one we're talking about right now. It's these individual banks. What's that?
Also, what he's saying is they do want to have more of that power, and they are on the path towards that by messing with the whole banking system.
Right.
And then central bank digital currencies, that kind of stuff. They may be on the path towards that, but it doesn't have to be that way.
Right, and we need to understand it first, because the reason we keep getting these banking crises, according to him, is that loans, again, and we should even use the word loans, money creation, a large amount of money creation gets directed toward financial transactions versus productive investment. What were you going to say?
Yeah. Well, I just want to sort of lay out the big picture of the regulatory response.
Good point.
So the theories of bank's an intermediary, or the bank is a fractional reserve bank. These have all led regulators to come up with things like minimum reserve requirements and capital requirements. So Basil, for example, says the bank has to, part of Basil, if I understand correctly, has to have so and so much equity and so and so much reserves. But neither of these approaches
addresses anything.
Well, if you're familiar with balance sheets, they address the liability side of the bank's balance sheets. Where does their funding come from? But it doesn't address the asset side of the balance sheet, which is what kind of loans do they actually make?
Mm.
That is really the only thing that that matters in terms of banking. Is what kind of loans do they make? I mean, it theoretically would even be conceivable, I think, maybe I'm wrong, but you could have a bank without equity, only
Loans,
only loan funding, only deposits funding. If they make good loans, then I mean, obviously, from the standpoint of profitability, wanting to make a profit and all that, then you have to have some equity so that the owners make some profit off of that. But technically speaking, it's not required for the bank to be sound. What's much, much more important, and it's such a duh moment, it's such a obvious thing. Obviously, it's what kind of loans do they make?
are they making good loans?
Yeah. So what you were saying is he's suggesting that the big problem over the past decades has been that banks have made loans to facilitate financial transactions, such as real estate purchases,
Or hedge fund speculation.
Margin lending for hedge funds, all these kinds of things that, if anything, they facilitate a rally in the price of certain assets, financial assets, but they don't create any value, such as, for example, a productive loan. Like a bakery wants to have a bigger oven and they take on a loan and then they make more bread and then they make more money and they can pay off the loan. And
they can hire more people and they can, yes.
Now the economy is richer in actual measurable people, like in terms of that we
goods
the
and
people,
services, yes.
Goods and services, yeah. So the more lending goes into these financial transactions, the more it'll be inflationary. He also pointed that out. But
hold on, before we get off from that, I think that's huge because inflation is such a big topic, right? And in terms of our generation, because we all know our generation and the Zoomers, Nima and I are millennials, and the Zoomers, Generation Z, we've got this bitter fight between us and the Boomers because the Boomers inherited a completely different economic system than we did. And they, it's irritating what we hear from the Boomers, but at the same time, I don't think that the millennial vicious response is helping anything. Because I think if we want to say, okay, well, a Boomer back in 1959 or 1963 could get a job out of high school and buy a home and raise a family and have savings and all that sort of stuff, and that's just completely out the goddamn window now because a starter home's $500,000. Right? And I mean, I'm not saying that that's not true, but I'm saying is I suddenly have a very clear understanding why, at least from and I don't want to say that this is entirely a banking thing, but from the banking thing, if money creation is being aimed at these financial transactions where you're not creating anything new, by necessity they're inflating everything, well, of course the price of housing is going to go up. Right? As opposed to if we go toward productive stuff, which is say, where's a productive business that we can create this money for? Well, then the money creation would be aimed more at the productive businesses, less at the real estate. The real estate could either come down or at least stay stable, and that people could make more money. Let me turn my camera off. People can make more money because there was more stuff invested into production. I need to zoom in on this with my sucky eyes. Okay. Well, he's smirking. He's got some memes up here. Drives up federal deficit for 30 years, hands the bill to his kids. Well, we have something to say about that. Graduates from college, gets hired. That's one different. At my first job, I only made $15K a year. In 1979, that was the equivalent of $47K. Yep. Got my dream job by responding to a classified ad. Graduates college, doesn't move back in with parents. Yep. Followed American dream. Did not wake up yet. Yep.
Old Economy Steve is the name of the meme, I guess.
Oh, Economy Steve. So, Inflation is just what I wanted to address, and that if currently the banking system or the banking theory doesn't really differentiate between what type of loan is being made and therefore doesn't regulate it. And Werner points out that this is really a question of regulation. If the regulation came down and said, okay, stop, doing all this speculative money creation for financial transactions, which will lead to a bubble. He does point this out, right? Because if you're just funding financial transactions and there's no real growth that happens behind it, the only way that game continues is as long as the bank continues to pay create money for future financial transactions, which leads us into the situation that I've described a million times from the MMT perspective. That can only keep up as long as the government is keeping up enough deficit to fund the system, right?
Yeah.
Because the private sector can only go into debt so much with itself.
He singles out, at the present, he says the ECB has been particularly egregious in terms of facilitating financial speculation in Europe. They did that in Germany. I think the interview was in 1918. He said, check me out in 4 years. There's going to be a big bust.
You mean 2018?
2018, yeah.
He said 1918. I was very confused, but I figured it out. The interview took place in 2018. That's what Nima meant to say. Yes, go ahead.
Right. He says that they're blowing up a bubble in Germany right now, and it's going to probably bust in about 4 to 5 years. So this is where we are now. Real estate prices have soared incredibly in Germany. I was just there. But they've stopped rising. They are coming down now. It's not necessarily bust yet. But now you're seeing, all these economic issues.
Did the interest rates go up in Europe as well?
But they just started going up, but not as in the US yet. But they just started for the first time in 11 years or so. I think they started raising rates at the ECB. Yeah, so that's probably also playing a bit of a role in terms of property prices.
Well, and then I do want to emphasize this, and we've talked about this in private conversations several times. When it comes to housing, particularly on a 30-year loan, most people aren't actually buying it on the price, they're buying it on what they can afford with their monthly payment. So if you look at the amortized loan, as you increase the interest rate, the payment goes up. So if you need to keep the payment the same and the interest rate goes up, well, then the price has to come down. And nominally, it looks like the price went down, but in terms of the actual money coming out of your pocket, it didn't change. If you want to figure out that math, go play with a mortgage calculator and you'll figure it out. But I did want to emphasize that, yes, they're coming down, kind of.
Yeah.
I totally interrupted you because you're moving on to the next point to talk about inflation. Do you remember what the next point was?
You mean what the next point was about?
You mentioned inflation when we were talking about productive money creation versus financial, and then you're about to move on to the next thing, and I stopped you.
Oh, I don't know.
Okay.
I thought I was just talking about how encouraging the lending for financial transactions and for speculation, margin lending, property, real estate, etc., doesn't add to the productive capacity of the economy. So yeah, that's inflationary type of lending. But he also goes into later on how you can have lending without inflation, which obviously you lend for productive purposes.
Well, and then
the amount of goods and services keeps up with the increase in the money supply in the economy.
And he makes an interesting point, I think, jumping from this part of the conversation, is that there's no reason to have a banking crisis ever. There is no natural boom bust cycle that we have to follow, like it's a law of nature or something. These banking crises are a result of us. Well, maybe the people in charge do understand and they're just willfully ignoring it. But whatever the case is, it's us not using the system correctly. I mean, if you have a gun and you keep shooting yourself in the foot, and you make the determination, well, all guns do is shoot you in the foot. Well, you're not using it very well.
There's no need to have a financial crisis, I would say. You may have a banking crisis, but the government can always...
They can fix it.
Fix it. Now, what where maybe Minsky would slightly disagree with that statement, because I think Minsky was almost a step ahead of everyone in this regard, because Minsky said that the banking system will constantly innovate around the roadblocks that are put in place to clamp down on speculation, to prevent excessive Ponzi finance, all that kind of stuff. So that's just one thing to be aware of. There's a natural incentive in the banking system to innovate around these restrictions.
Well, let's talk about how Germany has dealt with that. I'm not disagreeing with you, but Werner actually brought up that Germany apparently has the best banking system in the world. I would not have guessed that. And it has to do with the fact, start from the beginning here, is recognizing that the size of the bank determines the size of the operation it lends to, which I mean honestly makes sense. A big bank wants to make big loans to big business, medium loans to medium businesses, and small loans to small businesses. I mean, if you're a big bank,
research, by the way.
Confirmed by yes, and I mean it just makes sense. If you're a big bank, like, do I want to listen to 4 million people come through my office asking for $5,000, or do I just want to make one $200 million loan? Right? I'm not criticizing a big bank for wanting to make big loans, right? But with Germany, he points out that, at least in 2018, that 70% of banks in Germany are small to medium banks. Whereas, like in the UK, it was like 90% are, and when I say this, 70. I think it's not that 70% of the banks were small or medium. I think the proper way to say it is 70% of the money creation came from these banks. Nima, you could confirm or deny if you remember on that.
Not sure. Yeah,
and then in the UK, it was more like 90% from big banks and 10% from small banks. And the result that we see is in Germany, it is the absolute, it rivals China with exports, despite having like 1/15th of the population, and they rule the what did he call it? The
hidden superstars. Or
something like that. The hidden superstar market, which is to say, there's a lot of niche markets that German companies that we've probably never heard of are the top producers in. And he says the reason for this is because Germany has this community banking system that aims at, okay, the small and the medium, the small and the medium, the small and the medium, right? And furthermore, he said that Germany passed a law that addresses the point that you were bringing up before, is how do you slow the banking system down from making these speculative loans, to resist the urge to make these speculative loans. And he said the issue is, and this is totally hilarious because Dan Pena taught us to do it the way that he says is the problem. The issue is the relationship banker goes out and meets the business owner, and they get emotionally involved in the deal. They get emotionally involved in the person. And so when they come back, they want to give the loan. Maybe the underwriting isn't that great, but they have an emotional connection. They say, I like this and I want to do it. In Germany, it is illegal for the person who's the front side that goes out and talks to everybody to underwrite from the back end. You have to have two different people, one that looks at the cold hard facts, and one that goes out and interacts with the business owner. And then they independently have to give it a thumbs up or a thumbs down. And when they meet after making that decision independently and they're both thumbs up, then the loan is made. Apparently, that is a huge deal to addressing, Nima, what the issue that you just brought up. And ironically, so when I learned how to talk to banks from Dan Pena, he told us specifically you have to get the bank excited. Like, talk about your deal is like the best thing since sliced bread. And he said it's super duper important that you get in contact with that bank person, with the credit officer. And I will be kerfucked if I was able to get a credit officer on the line with over 20 banks for trying to fund my deal. Could not do it. And I'm wondering now that I listen to Professor Werner, that maybe the American banks have started to pick up that that's a good idea.
Yeah, he doesn't really talk much about the U.S. banking system actually, because he's been in Japan, he's from Germany, and he's worked in the U.K. a lot. So I don't even know at this point where the U.S. banking system stands in his evaluation, but I think it's possible that it's maybe somewhere similar to Germany, because the U.S. also has a lot of small community banks, even credit unions that lend to small businesses. And so, I would be surprised if there was similar kind of setup in the U.S. as is in Germany.
Well, I want to get up how to set things up, but before that, I do want to mention. So you brought up Japan. This guy was during the Japanese banking crisis in the 80s and 90s, he was in Japan advising the top Japanese people in the finance regulatory whatever what to do. Also,
he made a documentary called Princes of the Yen or Masters of the Yen.
I think it was Princes.
It was a book, and then there's a documentary to it, and one is named one way, one the other way.
I see. And then apparently he was advising Ben Bernanke in 2008, and he said Ben Bernanke was the only central banker that actually took his advice when it came to quantitative easing, which apparently was the right thing to do, despite what all the Austrians have freaked out about since.
Well, because quantitative easing, the term has been bastardized since he coined. So apparently, this guy Richard
came up with quantitative easing. Yes,
came up with quantitative easing, but it was a specific policy. So he talks about, okay, so we have Japan in the 1990s with all these banks having made bad loans. How do we deal with that? Right? And his suggestion was central bank buys all the bad assets from the banks so they can start lending again. He talks about how people are saying, well, that's inflationary, that's moral hazard, etc. And moral hazard, I may agree to some extent if it doesn't come with some sort of
correcting thing with it. Yes,
but you got to do something. You got to go somewhere. It's better to have your banks start from a clean slate again than having them sit there with all
and then having the entire economy go to shit for
nothing happened. He talks about how the Japanese banking system in 1989 had maybe something like
25%. It was 20, I remember what you're talking about. It was 25%
bad loans, right? And he goes back to, I believe, the 1930s.
No, he goes back to right after World War II.
1940s. So Japan has been bombed to rubble. Everything, cities.
If you don't mind me picking up, I think I remember more specifically than you. He said that the banking system in Japan, during and right after the war, was wrapped up in two things: one, lending to the government, obviously for military purposes, and two, lending to areas of Japan that weren't areas of Japan after they lost the war. This is like Taiwan, Korea, and Manchuria. And so after the war's over, 100% of the bank's assets were bad. All of them. And on top of that, in Japan at that time, he did mention, and I hope I get these details right, they didn't have like a corporate stock finance raising option at that time. You had to go to the bank to get your money. So like the banking economic system in Japan was about as level as all of its cities right after World War II. And what
they're lending to armament companies and stuff like. I don't know if they lend to the government. You just said they lend to the government. I don't know, but maybe to municipalities and provinces.
I think you may be right. Armament stuff, which obviously they're not doing that after they just lost the war. No more armaments. Yes,
your creditors are, dead possibly.
Yeah.
You're not going to see that money again. So 100% bad loans, and in response to that, they did quantitative easing, at least how he defines it. They bought all the bad.
The central bank bought everything at face value.
Yeah.
All of it. And then what? And then here's the thing he points out. What happened right after that? Japan was the economic miracle. Right? And in the 90s, going back to what you said, they had 25% bad loans. And they did have the corporate money-raising stock finance option. And they decided to play with interest rates. And what happened? Stagflation for decades.
Yeah, they created a very long recession and deflation and very undesirable conditions in general. And also, how did we get there? He talks about that in his documentary. It's because the banks and the central bank abdicated their responsibility to direct the loan creation. And money started going towards financial speculation, property price, etc. At one point, I think there's one square in Tokyo was worth as much as all of California or something like that.
I remember hearing about that story, yeah.
It was the Emperor's Palace, to be fair, but still, it's just a lot that it was on. But generally speaking, once again, I think Professor Werner accurately identifies the cause of the 1989 Asia crisis and then the subsequent American crises as a situation where bank lending was not properly directed. And a lot of it started going to financial speculation. It caused all the undesirable outcomes that we've seen since then.
And what he found, because, okay, this is explosive information. It totally explains how everything works, and we got a game plan to go forward and fix everything. So he goes around telling all the high finance people in all these different countries and all these central bankers, and he says everybody agrees with him, nods along, says yes, that is a better way to do it, and then they don't implement anything that he ever says.
Right. Similar to what Warren Mosler has told us. They all understood what he said. They agreed. They were able to rephrase his arguments.
Back at him, yes.
That they really grokked what he was telling them, but they didn't make the changes that he recommended.
And I mean,
I said, well, let's get into that, I guess.
Well, and then I mean, I did read another article by Werner that he thinks that because the central banks want more power and the people who are in charge want more power, they like the way that it is, and specifically via the current interpretation of the economic system, which we could make another show talking about, breaking down his article because he really breaks it down. It obfuscates who's responsible. So when a problem happens, the people who are in charge and do have the ability to fix things can go, oh, no, that person did it, and that organization did it, and they were all the ones responsible, so everybody look over there. So if that's... What's that?
I'm just seeing some chats that came in, so we can respond to those in a sec.
Oh.
So, hi, Tommy. Preach it, Dylan. Okay, Jesus asking, why not push for federally funded public housing? That should bring down the cost of housing. Oh, okay. Then he also says, maybe we can go back to the post office being a public banking institution, which can only lend out for business reasons, absolutely no consumer reasons. Yeah. I mean, that's...
we could talk about the moral hazard and pitfalls associated with going through the government like that.
Right.
But I do get his point.
Yes. So
yeah.
The thing is, like you said before, banking is a public thing anyways. I mean, it's public-private nowadays with the so-called private banks, but it is still a government license, and you're getting government privileges to do that.
To create money, yes.
Create money, yeah. I can't do that right now unless I have a bank. So the post office, like in Germany, was actually the same. There was, and I think it was probably all over the place. The postal offices were also banks, which makes sense because they had all these routes. You know, banking was in many ways, to a large extent, just logistics, and having access to something that people can use as a medium of exchange. One point, I guess, it happened to be gold, and that's how the Rothschilds expanded their empire under gold standard. But yeah, so postal offices did that a lot all over the world, especially in Europe, that I'm aware of at least. And what he's suggesting is basically, well, why not make the government into a bank and let the government lend? And that would be one option. But what you lose when you do that is the competitive aspect of different banks competing for loans and finding the best projects, having the desire to fund innovative projects. So you probably get some more stability. You lose out on some innovation in doing that. And the current banking system, if it was publicly regulated, if it was more soundly regulated, would be something like what he's saying there. It would be kind of like a step in the direction of.
Yeah, I was going to say something similar, because if we take what I just described in terms of how the German banks are set up, where the front office can't be the same people as the back office, and we're regulating correctly, theoretically, we'd stop shooting ourselves in the foot with the gun, going, well, all this gun does is shoot us in the foot. Well, maybe we should get rid of this thing, or maybe we should use it correctly. And I don't think it would be. I think we could have incredible improvements if we just adopted the right theory of how the damn thing works.
Yeah, that's the start.
Right?
You know, if you want to get anywhere, you're not going to get anywhere if you're operating on a false theory. And that's what we can get into now. Why is that the case? Why do we have this system? Everyone uses it. It's been around for so long all over the world, yet we can't even empirically establish how a loan is actually made. Why is that? Well,
oh God, I think we should have an own show for this. But go ahead.
Well, I think it's still part of this topic, is why is the banking system so secretive? Why are the central banks so secretive? Why isn't there more public education? Well, it's because that's part of their it's an asset for the banking system. It's an asset for the big banks, for people to not understand what the hell is going on, make it look like some kind of super complicated wizardry that we can't possibly see through. So
that's somebody else's fault. Yes.
Right. So it's let the experts deal with it. Once again, we see this all over the fields,
always the experts. Yes.
Do
we need to read the Carol Quigley quote again? Do you have it ready?
I think I've bothered you enough with it. We have the same approach in different fields. So maybe that's also kind of helpful in understanding why is it like this. We've just had it in health, where we have the health authority telling us that there's numbers of COVID cases in different regions. And so here's how we fight those COVID numbers, is by wearing masks and getting experimental injections from the pharmaceutical companies. And then they do those things, and there's never any correlation established between the two things.
And there's never any follow-up, right? Like, oh, we did this, and there was no correlation. Maybe we should change what we're doing. No, none of that.
No post-mortem. It's similar with the central banking approach, right? Oh, we have inflation. Let's raise the interest rates. Did raising the interest rates stop the inflation? No, we still have inflation.
We'll raise them some more. Yeah.
Let's keep doing it anyway.
Yeah.
You know, that's from field to field, from industry to industry. We see the same approach of the centralizers. They create crises and obfuscate the situation and present themselves conveniently as a solution for the crisis.
Well, you aren't bothering me by bringing up the Carol Quigley quote again, but I'll see if I can paraphrase it, because I think it's worth bothering everybody else with, which is it's something to the effect of experts in anything can never be trusted because they become the vested interest in the thing that they're the expert of. Right?
He says everything is too important to entrust anything to experts, and that's because the so-called experts in any given field, they are more interested in maintaining their own status and aggrandizing themselves than reaching the objectives that their organization supposedly has.
Right.
Yeah,
Like
just
the banking organization supposedly, I mean, if we have the right theory in mind, is supposed to create money for productive purposes, right? No, we don't do that.
Exactly.
We serve ourselves, and we have this crazy story to make sure that you don't understand what's going on, so you don't catch on to the fact that we're serving ourselves. Go ahead. You want to read that verbatim?
Well, but everything is too important ever to be entrusted to professional experts, because every organization of such professionals and every established social organization becomes a vested interest institution more concerned with its efforts to maintain itself or advance its own interests than to achieve the purpose that society expects it to achieve.
Ding. Maybe the whole book of Evolution of Civilizations could just be replaced with that one sentence. So Werner realizes that no one from the top is listening to him.
Yeah. They're not going to listen because they have no incentive. They don't actually care to even achieve those objectives that you're talking about, dude. They're not interested in a productive economy, in a prosperous population, in a vibrant economy. That's not what they're interested in. They have very different interests. We don't even know what the end goal is for a lot of these people, but there's a lot of things. And it does seem to involve things like population reduction, making people more dependent,
removing the boundaries between the layers of government.
Yes. None of these things have anything to do with productivity and expansion and business and prosperity and all those things. Those are the stories they tell us, but the things they do paint a different picture.
So Werner says that he decided that from the top down isn't the appropriate approach. From the bottom up is the appropriate approach. And again, he turns around and he looks at Germany and he says, Germany's got it handled the right way. They've got community banks that apply their money creation toward small and medium productive concerns.
Yeah, so, one caveat.
Yeah.
He's also that the ECB has been at war.
I was just thinking about that. Go ahead.
So the one thing that's working, the European Union is currently working really hard to dismantle and get rid of. They want to have a system of big banks and ultimately the central bank being in charge of directing the flow of credit for purely power purposes, not to create a great economy, but to create a vibrant, prosperous economy.
Right. And it goes back to what you just said now and what you've jumped up and down a lot. This is all about decentralization, right? We have to decentralize. And this is the thing that really excited me. And Nima and I are already like, should we start a bank? Is that if, how do I want to say this? If we want to create whatever we want to create and we need money to do that, why aren't we figuring out how to utilize or even create our own community banks in order to make that happen? Because if we recognize that money creation is what banking is, and that's fine, that's just what it is. Like, we don't need to be like, oh, this is the most evil thing because of fractional reserves, something or other. Oh, yeah, that was a great article. I think we could do another show just on that. Lost my train of thought. Nima.
Well, why don't we do these things? Why can't we? If we
why can't we do these things? I mean, I feel like all the people in the in quotes liberty movement, the people who are recognizing these massive issues, and they're like, oh my God, we need to fix this. We need to fight back. They're all begging for table scraps. Right? Maybe you're Alex Jones and you're the best at begging for those table scraps and you can make some money at it, but everybody else is begging for table scraps. And at the same time, they're going, oh no, the banking system's evil. The banking system's evil. Don't look at them. Oh my God, the central bankers and the Rothschilds. Oh, we need to go create our own system. No, the system, it's a tool. It's there. You could use it. Right? Like, I mean,
okay, I'm going to fight the system by buying
some gold,
a shank of ham with my silver dimes. Haha. Can you feel them shaking in their boots?
Yeah, right. And I remember my uncle once. He owns a trucking business. Nima, did I just freeze for you? Uh-oh.
No. Oh, now you did, yeah.
Uh-oh. Okay, everything's
Yeah.
working. Everything's under control. I'm moving. It's working. So, I think this was not long after the 2008 crash that he went to a bank to get a line of credit, and the bank told him no. And he told me this story about how he was all upset that the bank told him no. And at the time, I didn't know anything about banking. I'm like, I don't know what to tell you, uncle. But now I know. I'm like, you asked one bank? Right? Like, you know, banks I talked to get my deal done? It was over 20, right? So it's frustrating to hear from people. It's like, okay, here's what I'm trying to do. Here's this big evil banking system, and I can prove it. I went to a bank once, and I got a no. Like,
funny because my uncle, I have a similar story from my uncle. My dad told me again the other day when I was visiting my family in Germany. And because my uncle had this, he's a physics PhD, he has a PhD in physics, and he had this great solution to the battery problem. Like decades ago already, he presented this solution that he's patented to make efficient batteries for electric cars and all these things. But they weren't interested, is what my dad said.
The banks weren't interested, or nobody was?
He pitched it too. And then I just told him, well, then he didn't sell it well.
And how many pitches did he do? 3?
Like, that's so true, that whole attitude of persistence. You have to have that attitude, or you're not going to be successful, period. That's what, there's this famous quote from Calvin Coolidge about persistence. Persistence is key. There's a lot of people of talent. There's a lot of failed talents out there, failed people with talent out there. But what all the successful people have in common is persistence.
Well, Bill Gates' quote actually comes to mind. I'm going to say something nice about Bill Gates. You ready? So, presuming this is true, when he was back at the beginning and he with Microsoft and he needed to raise money, I think he said, we did 100 pitches, 80 of them told us no, 15 told us cool idea, but maybe, and 5 said yes. Have you done 100 pitches for your idea? Right? Like how badly do you want it, man?
Yeah. Well, I wonder if those 5 were like his mom and her friends on the board of IBM.
Well, that still counts. I mean, you use whatever connections that you have, right? Uh-oh, Nima. You're getting Zoom lagged.
I was trying to Zoom, but it didn't let me. Oh. Well, anyway, I just got the Calvin Coolidge quote. Nothing in the world can take the place of persistence. Talent will not. Nothing is more common than unsuccessful men with talent. Genius will not. Unrewarded genius is almost a proverb. Education will not. The world is full of educated derelicts. Well, isn't that true today even more so? Right. Persistence and determination alone are omnipotent. The slogan, press on, has solved and always will solve the problems of the human race.
Absolutely. So, I mean, I guess we kind of changed subjects from banking to like persistence, keep going, try. But I mean, the point still stands is that, look, if we want to actually do the thing that we want to do in the universe, whatever that is, we have to have a theory that's in some level, some way consistent with the way things actually work, right? Banking is a big freaking deal because it creates most of the money that all countries have in their almost all countries have in their system. I just thought of North Korea. I'm like, do North Koreans have banks? I don't know.
Yeah, but probably not. But looking at it in terms of Carol Quigley's terminology and the instrument of expansion, right? That is our society's instrument of expansion, right there. It's a banking system.
Mm-hmm. So what that banking is. Okay, well, and then it has institutionalized because the banking system serves itself instead of serving its original purpose, and so therefore the reform, or I guess in this case, the circumvention would be, instead of trying to go to the central banks and say, bam, we want you to do this reform, we say, okay, we will circumvent you with the local banks. And it makes me excited to talk about this sort of stuff, Nima. So, do you have anything more to add to this other than we need to call Professor Werner.
There's so many directions we could shoot off into, but I have to, go to training and fight with some people.
Good.
No.
I hope you fight with a banker. Be like, fund my project, motherfucker. Tap you out. Okay, cool. Well, this has been Dylan Moore and Nima Majura of iRead TV. We've been here doing it live. You can check us out at iRead.tv. And, dude, we got our YouTube channel back. Which kind of sucks because now we're not banned anymore. And we can't say, we're the cool kids who got banned by YouTube. But for anyone who lost their YouTube channel, just send them another message now. I literally wrote them a message. I said, I don't understand why we got banned. Can you tell me why we got what was the thing that we did that got us banned? And then within like an hour, I got a message back going, yeah, we don't know. Here's your YouTube video back, or YouTube channel back. Okay, so I guess we're gonna start posting stuff on YouTube again until we until we get cut off, and everything won't be on YouTube. We're not going to cover the verboten issues, the forbidden issues on YouTube. We'll be putting them all on all alternative new social media sites, but we could still fish for people on YouTube. Anyway, that being said, Dylan Moore, Nima Majura of iRead TV at iRead.tv. Thank you for watching. This has been us doing it live, and we'll see you next time.
We'll do it live. Okay. We'll do it live. Fuck it. Do it live. I'll write it and we'll do it live.